Okay, welcome everybody. This is Kurt Frankenberg, one of your hosts, and I'm joined by my good friend, Mr. Mike Tepka. How's it going, Mike?
Oh, things are going pretty well here, Kurt, and keeping an eye on the market, and of course over here in the Mid-Atlantic we're keeping an eye on a couple other things for next week as well, so it should be an interesting weekend and start to next week, it looks like.
Is it weather going on there? Or?
Oh yeah, a combination of the little Arctic front that's going down here, and then that's coming down our way, and then of course the storms that are rolling through your area might have already passed, and Hurricane Sandy coming right up the coast as well at the same time. So it should be pretty interesting.
How about that? I need to stay a little more connected. It's snowing in our backyard, so
yeah.
Well, very good. Gang, we sorry about starting a few minutes late there. I accidentally was going over some of the slides and so forth, and then got a phone call, and the phone call actually woke me up. The phone call said, the phone call came in right at 12 o'clock. 12 o'clock Eastern Time, 10 o'clock my time. So, folks, my apologies for running late. Now, today's webinar is going to be rather brief. We're going to finish right at the top of the hour. Okay, so that's going to be helpful. Mike, this is actually going to be a variation on what we did on Tuesday. In light of the questions that we got, I adjusted the slides a bit, and I know that folks are wanting to see some things again about that ratio call spread that I'm able to do at zero risk. And so we plug that stuff in there. Folks, I want to mention to you, we're going to skip an intro. You're here to hear what we have to say, not you probably don't care who we are. And if you do care, you can get to know us certainly through these webinars and email and other means. But so we're going to skip the intro. I want to mention the way to get the most out of today's lesson. This is a class today, okay? The way to get the most out of today's lesson is jot down your questions as you think of them, and hold them until the time where Mike and I will be able to pause and take a few questions, okay? And then along the way, we're going to want you to participate in the polls and the prompts for two reasons. Number one, the polls will help you to formulate a concept in your mind. Some of the some of the questions are meant in themselves to teach a lesson. But then secondly, it'll help Mike and me to pace this properly, okay? To know who we're interacting with and be able to pace it properly. Now, I want to mention that today is going to be a class, okay? So if you're getting that sales resistance face on, if you think that what we're doing here is a 60-minute commercial, it's not going to be that way. Here's our mission, and number one, it's to provide the best options education available. Mike is the director of options education over at PowerOptions. And me, Kurt Frankenberg, I'm a fellow that wrote a book about trading options back in 2002. It was finished in 2003, and we have made 11 revisions to it in light of changing conditions and learning new principles and networking with folks from all over the world that are using the radioactive trading principles. It's targeted at keeping people out of trouble. Our mission is targeted at keeping people out of trouble, and also raise awareness of how the married put strategy combines position sizing and absolute stops, but allows for one to take out income out of their stocks, kind of like what we were promised when we went to those cover call trading seminars. Wow, okay. Mike, are we ready?
I think we're ready, sir.
Rock on. Okay, so put your checkbook away and forget about your credit card and so forth. I'm not going to make a big one-time only offer at the end of this deal here. Okay, the webinar is all about just content, 100% content guarantee. We're going to take a common problem for traders and we're going to fix it. At the end, I may point you out to some further free resources, okay, but no sales pitch. And that's what to expect from today's RadioActiveTrading.com webinar. Let's get into our viewers, Mike, and find out what they're all about and why they're here. Mike, I'd like to do one poll, okay, and just ask one question. The poll is, what kinds of options plays are you doing now? Okay. And the question is, once you've cast your vote and you get a chance to type it in there, how did you come to be with us today? How did you come to be with us today? Okay? All right, so first off, what options trading methods are you currently using? And you can put in more than one of these. If for example, you're doing covered calls and you're doing spread plays, okay? Or if you're doing long calls and puts and you're also doing spread plays. Or if you're doing all three, go ahead and let us know. If you're not trading options at all, let us know. Wow, Mike, do you see this? I haven't seen that many answers in the covered call category in a long time. That's something else. It was up to 90% there for a moment.
Yeah, and it's still holding. No, it's dropping a little, but it's still up there. Not what we typically see.
Yeah, that's really something else. And well, that helps us know who we're talking to now, doesn't it?
Mm-hmm.
That's pretty good. Okay, good. Mike, I'm going to go ahead and close that poll, and I'm going to share the results. And how are you doing? Are you getting past that cold and everything?
Oh, yeah. I think last night was my last day. I got a little lingering cough here, but other than that, I'm okay.
Okay, good. I'm going to let you do a lot of talking then.
Okay.
Last time we tried to minimize your talking so that it didn't mess with you there. But okay, so let's talk about the results here. What have we got?
Well, as we saw, we've got 80% of our audience doing covered calls and naked puts. Now, one thing I always say about my clientele here at PowerOptions is that when a customer asks, how many of your clients trade covered calls or what strategy they trade the most, I usually say covered calls. But since you can answer multiples on these, some of the 33% that answer they're doing verticals and diagonals, they may also be trading covered calls. For example, I know several of our customers who trade a lot of spread trades, but they have holdings in their account, for example, stocks that they've had for years, and they're just selling out of the money calls, maybe collecting a dividend. So technically, they're still trading covered calls, but that's just not the mainstay. But yeah, we're seeing a strong proportion. Everyone here is almost pretty much familiar with covered calls. Second place is long calls and puts at 53%. And that's pretty high too, isn't it?
It is. Very often we'll see like 20-30% in that category, and today we've got more than half of the people that answered the poll. More than half are trading long calls or long puts, and a kind of a low number on the spread trades. On Tuesday we had oh gosh, I thought it was over 60%. I think it was 68% or something. Mm-hmm. Ridiculous. I mean, it was like twice the amount of folks that are doing spread trades today. Folks, maybe one of the reasons that you don't do spread trades is that they do have inherent risk. But today I'm going to be sharing a play that has no risk. No risk. And I know it's hard to swallow, but it's the truth. I dare you to poke a hole in it. I'm really going to show you a credit spread that can be done in the right context. You understand? If it's done in the right context, it has no risk at all. So the 7% that aren't trading options at all, I'm going to say, thanks for being here, and we are going to say some concepts that will be a little bit foreign, but then most of what we're going to be talking about is very straightforward. Okay, and Mike, are we recording today's?
Yes, sir, I am.
Oh, happy day. So it's real likely that you can step in if you need to review the material. Mm-hmm. It's going to be available to you. So marvelous. Okay, so let me go ahead and hide that. One of the fellows that answered, "How did you come to be with us today?" Happened to say that, geez, there's so much risk with spread trades. That's why I'm here today. I want to listen to what you all have to say about a riskless spread trade. Okay, so we are going to get to that. I am going to make 3 bold promises and test me, folks, if I deliver. Okay. The first thing I'm going to do is show the solution to a big problem facing buy and holders today, and it'll make a lot of sense. Okay. In fact, I'm willing to bet that you'll take a look back at your trading record and wish that you had maybe thought of this sooner, because it's an answer that's in plain sight, but most folks don't do it because it doesn't seem exciting. It doesn't seem sexy to do, but it's a real no-brainer once you see how it makes sense. Okay, number 2, I'm going to show a riskless spread trade, one which is done in a credit, and normally a credit spread involves risk, but remember I said it would be riskless in the context in which I show it. What's really exciting about this is this riskless spread trade can pay you twice. Okay. Number 3, I'm going to show you how it's possible to really, take income from your stock without necessarily selling it or limiting the upside. So that's what to take away from today's class. And since I'm trying to follow that Toastmasters thing there, Mike. They say tell them what you're going to tell them, then tell them. And tell them what you just told them, right? Yeah, and that's, I think, the best way for a classroom experience. Folks, this is what to expect from today, okay? All right, let's do a baseline reading. I'd like to ask folks on the line how happy you are with your trading results from the last 12 months, okay? And please participate if you've been trading for the last 12 months. If it's, if you just got out of a seminar last month and you've done a couple of credit spreads and you got burned, or you did a couple of covered call trades and you did well, you know what? Don't answer this poll. Let's only stick with the folks that have done at least 12 months worth of trading. Okay, and I think that's going to yield a more accurate, consistent result. Okay, so far we've got nobody at the extremes. Nobody is saying, man, I am so happy with my trading, I couldn't be happier unless I was twins. Right? Nobody's saying that. Nobody's saying I'm absolutely kicking butt and taking names. But nobody's saying that they're ready to quit either. So that's encouraging. It's a good thing. Mike, let's break this down. Okay, it's been 1 minute. Okay, let's examine these results. How about that? Everything's a multiple of 11.
Oh, okay. Oh.
Okay, so our winner is making money, but not enough.
Okay.
As far as out of the 5 categories, the top answer is, hey, I'm making money, but not enough.
Mm-hmm.
And then the rest of the audience is distributed among, well, mixed emotions or, ouch, I lost money last year. That doesn't surprise me, Mike. Why do you think that doesn't surprise me, that a third of our audience not only lost money last year, but they're saying, ouch?
Well, because a lot of the strategies that we see advertised and the ones that our attendees voted on, covered calls, for example, Kurt, and then we looked at the spread trades as well. Well, these are highly advertised. The covered calls are promised, hey, you can make 3 to 6% per month consistently, and if you compound that, you'll do extremely well. And the spread trades, hey, how would you like to just put up less money and make 20% of what you invested every month on every trade? Well, yeah, what they're not talking about is that when you do a standard credit spread, you might have a leverage trade where you're looking to make 20%, but you're at a 10-to-1 or a 9-to-1 risk-reward ratio. And with the covered calls, you can easily find positions that might generate 3%, but if the stock drops 15 or 20% over those first 30 or 60 days, well, now you've got a loss of 12% or 17%. It's unrealized, but you still have a loss in your account, and it might take you several months to get back to break even. Or if it just keeps falling and you keep rolling down, before you know it, you might be 40 or 50% down on a given stock position. The downside isn't addressed, Kurt, so that's why even with those common strategies that are highly touted and highly advertised, they do have a dark side, and that's where we get hurt, and we usually get hurt painfully.
That's right. With the covered call play, for example, you limit your upside. You limit your upside potential, so you really don't win as big as perhaps you could without that short call. On the other hand, if you lose, well, all the risks of stock ownership go along with the covered call play, because you hedge it a little bit with the income that you take in, but very often that doesn't match up. You might take in 3% or 5% on your short call, but then the stock goes down by 10%. So how's that a gain? It's not. Right, so I'm really not surprised to see 22% saying mixed emotions. You win some, you lose some, and hey, I'm losing too many. Or, ouch, I lost money last year and it hurts. Okay, so let's talk about solutions here. And what I'm going to do is I'm going to offer, first of all, we're going to offer a solution to a problem that's, again, it's common among traders, but it's also, it's also a solution to folks that don't have the problem, if that makes sense. It's like prevention rather than a cure. Does that make sense?
Okay, I'm with you.
Yeah. Okay. So folks, if you don't happen to have stock that's up from where you bought it, this is still going to be a really cool class for you. Okay. But many of you may be in this place where you have stock that's up from where you bought it. Okay. And that's a good problem to have. All right. So now what? You know, the whole idea is, well, okay, my stock is up. Do I sell now? You know, and lock in my gain, and by the way, also pay my capital gains tax, right? Or do I hold on to it and then maybe see my stock turn back around? Okay, so I wrote a couple of haikus about this, Mike. If I sell my stock and it keeps going higher, I'll miss the boat. Well, that's no fun. That's happened to me before. Gosh, you know, I got into a stock one time and it went to 10, and I placed a limit sell order, right? That if it was going to get to $12.50, that I'd sell. Well, you know what? It went above $40. Went above $40 a share. You know, I got out at my $12.50. You know, but that kind of stunk. You know, to see the stock have those kinds of gains, that kind of success, and me not being with it. Okay.
Mm-hmm.
But here's another thing, and I know that we've both experienced this, Mike. You maybe you could relate your experience. You might get into a stock or re-get into a stock and end up giving back to the market everything that you've gained. You know, you might decide, hey, I'm going to hold this, and you see it go down, and then you can't seem to part with it as it goes down and down and down. You're thinking, man, it'll come back, it'll come back. Has that ever happened to you there, Mike?
Oh, yeah. I mean, I had in the Greek shipping heyday, I had one of those stocks where I made a large percentage of profits as the stock moved up, and I thought it had run its course, and I saw it continue to go. I said, oh, this thing isn't done, so I bought back into it, only to essentially give back most of my profits I'd already made on the position.
Ouch. Yep, and you know, I've done this too, where I've gotten into a stock and seen it go up, and then of course I can't sell it because, geez, you know, let's see how much higher it will go, and then she turns back around, and oh golly, Mike, there's a stock one time I got into for $8 and change. The
Mm-hmm.
stock go up to $24 and change, and then I saw it come back down, and I never got out until it was at 26 cents a share. Now, this is as an inexperienced investor. This is a long time ago. This is more than 10 years ago, and certainly before I learned the RadioActive Trading principles. Okay, but the point is, it is an emotional conundrum. You know, when your stock is up from where you bought it, sometimes it's like, geez, what do I do next? Why hasn't this problem been solved yet? Well, the thing is, we've only discussed two solutions, two choices, and there's more than, you know, two choices. We've discussed holding and perhaps giving back our gains, and selling and perhaps, you know, talking ourselves out of further gains. But there's another option, okay? And everyone's heard this little chestnut about cut your losers short, and what's the rest of it?
Well, we want to let our winners run. That's how we want to be successful in the market. It's easy to say, but it's not really easy to do, is it, Kurt?
No, not without a certain, not without rules, okay?
Mm-hmm.
Because the market is rampant chaos, and it only has whatever order we bring to it, okay? And few gurus out there are going to give the practical instruction on how to accomplish this, how to cut your losers short and let your winners run. Well, I'll tell you a structure that's exactly backwards from that, and I think our audience members will agree, since we've got about 80% of them doing this strategy, okay, doing the cover call strategy. Mike, does this cut losers short and let winners run?
No, it does the opposite, Kurt, doesn't it? It sort of cuts our winners short, but it does allow our losers to run. If I buy a stock, Kurt, and I sell a call, let's say I generate 3%, Well, that's great if the stock stays up and gets assigned, and I can do that consistently, which we don't normally see in the markets on a consistent basis. But what I have to remember is I'm still risking 97% of what I invested in the stock. And if the stock,
so the lion's share, of what you're putting into this is still at risk.
That's right.
Yeah, so it's kind of the reverse. Cuts winners short, lets losers
run. That's right.
Yeah. Now, spread trades the traditional way. Okay, just traditionally, I might sell a $50 call and buy a $55 call and generate a credit. All right. And only a third of our audience members is doing call spreads or spread trades. So this may not apply to everyone, but for that third of our audience, okay, you've probably noticed you can take in a credit, but if you're wrong, you can end up giving back your gains. In fact, Mike, is it possible to be right 80% of the time and still lose money?
Yes, if a lot of these positions that we see, Kurt, I'm going, bear call credit spread, for example, I'm going a reasonable amount out of the money to have a high probability of success, meaning there's a high probability that the calls will expire worthless and we'll keep the premium. Now, in a certain stock, any given stock, I might be looking to make 50 cents on a spread of 5 points. I might be selling a 50 call and buying a 55 when the stock's at around 46, 45. So I might generate 50 cents and I'm risking 5 points. If I open 10 trades that way, well, we take in $5. But if 8 of my spreads work out, we keep $4 a premium. Well, we keep the $5 a premium regardless. But if 2 of those 10 spreads go against me for the full 5-point loss, I've lost 10 points and only took in 5.
Yeah. In fact, gosh, you could be right 90% of the time.
And still just break even. Yeah.
Yeah. That's right. It would be a break even. I guess you'd lose on commissions, but it'd be break even as far as the spread. So I don't think this is the answer either. I mean, if you're right about it, if you're really, really right, you don't make any more money.
That's right. Yeah, if the stock dropped down to $10 per share on my 50, 55 bear call spread, I still make that 50 cents and that's it.
Yeah, you make 50 cents and that's it. You don't make lots of money. Okay, so I get this crazy idea years ago that if I was going to play, I would want to play a hedge that would put a stop on my losses, in one direction, but allow my gains to be unlimited. And that is in the married put strategy or the protected put strategy. And you can even do this in a down market. There's 3 different ways to play this backwards. Okay, 3 different ways to do the protected put strategy in a bearish manner. But the protected put strategy of itself is a bullish play. It's where you expect the market to go up, and it is safer, but the possible reward is unlimited. And so what I'm going to do now is show how to structure what we call a radioactive profit machine. A radioactive profit machine is a married put play, but it does 2 very distinct things that are different from the traditional married put. The first thing is that the put that you buy is in the money. In other words, whatever price your stock is trading at right now, you're going to buy a put option that's higher in strike. Okay, it guarantees you a higher payout than where the stock is right now. Number 2, instead of going out a month or 2 in time, we're going to go out several months in time. Okay, so here's the structure. Now we had an actual subscriber or attendee to one of our webinars. I asked, hey guys, who's got this problem? Who's got the problem of that they've got a stock that's up from where they bought it? And Carol wrote in, along with Ravi and a couple of other folks. Carol wrote in, she had shares of Visa card, and her cost basis was $84.60. Now later on, we're going to show how to do this exact same play that I'm going to share, how to do the exact same play, even if you don't have shares of stock that are up from where you bought it. Okay. But let's look at how this solves Carol's problem. Visa was trading at $120. Okay, on the day that she wrote me, it was trading in that range. It was right around $120. Okay, and so she had a gain to protect of $35.40, right? Cost basis was $84.60. The present price, not now, but then now, the present price was $120. So she had a gain to protect of $35.40. Again, she could sell and take the capital gains tax hit. She could hold and potentially see Visa, go down. But the third option is that she's going to put a fence around it. Okay, so here's her Visa shares of $84.60, and because Visa is trading at $120, this is in June, the September $125 put option was trading for only $10.40. If you add those together, that's a total that Carol has had to come up with of $95. But since it's a $125 put option, how much is she guaranteed to get back, even if Visa falls out of bed? If it pulls an Enron, how much is she guaranteed to get back?
Well, she's by buying the 125 put, we have a guaranteed floor. We're guaranteed to get at least $125 back for our underlying security. So she's locking in $30 of that unrealized gain.
Right. $30 of the gain that her stock has made is locked in. Now I told you she had $35.40 to protect, right?
That's right.
Yeah, 30 of it we're going to handle with just this addition of a put option. Now that doesn't seem sexy, does it? All right, but this is the new situation. The new situation is she's got a traditional married put looking curve here, or looking graph,
yes.
But there's something missing. What's missing?
Well, there's no break-even line, Kurt, and there's no loss. There's no potential for loss. The stock could drop down to $10 or $20 per share, and she'll still make $30 of profit on this position.
Yeah, she'll be very glad she invested in a put, okay? Mm-hmm. But I know that most folks watching are thinking to themselves, geez, that's a lot to spend. Why do I want to spend $10.40, to protect $30 of my gains? Well, let's dissect this just a little bit, okay? Fair enough. How might we finance the cost of that put option? A traditional way to do that would be to do a collar trade, where you do a short call, right? You'd buy a put option, then you'd also sell a call option. But that has the problem of making it so that you don't allow your winners to run. Does that make sense? Okay. But there's other ways to do it. First off, I want to mention that the cost of this put isn't really $10.40. Yeah, you come up with $10.40, okay? But remember, the stock's only at $120, and it's a $125 put option. So some of that $10.40 is guaranteed to come back, no matter what happens, right? Here's the deal. Since the stock is at $120 and it's a $125 put option that we're buying, $5 of that $10.40 is intrinsic value. It's like I just put it on deposit, okay? And so the difference of $5.40 is all that I'm really paying out of pocket that I'm not going to, that I potentially may not see again. Okay, and then another thing is it's several months out. In this case, it's only 3 months out. Usually when we do a radioactive trade, it's more than 3 months away. But in this case, it's 3 months out. All right, it's June, and we're buying the September puts. But if you think of it as an insurance policy, Mike, that's basically I'm paying $1.80 per month to take care of this stock and keep it protected.
Yeah, in this situation, that's right.
Okay. Now, what we want to do is we want to look at the income methods and how to pull in some money without necessarily risking anything at all. And here's my tribute to Monty Python, because this is something completely different. You've probably never seen this idea. I mean, you might have seen the ratio call spread by itself. That's what we're looking at.
That's a profit and loss chart of a ratio call spread. Yes, sir.
Right. What's the big problem with the ratio call spread?
Well, it's obvious. On the right-hand side, you've got infinite risk. That is an issue, sir.
Yes. The way that this is formed is by buying one call and selling two calls against the one, right?
Mm-hmm.
You buy one call and you sell two calls in order to take in more credit than you spent, okay? Now, you have a really interesting situation here because as long as the stock's price stays below a certain area, you keep your initial credit. As the stock's price goes up, you might actually get more of a credit. But the problem with the ratio call spread is that you've sold two calls and only bought one. And so you have a naked call. And, Mike, is a naked call pretty risky?
Well, it's the riskiest thing you can do, Kurt, when trading options. What is more risky than selling a naked call?
Two.
Selling two naked calls. That's right.
And what's more risky than that is selling three naked calls. It's the riskiest play there is. And most folks aren't even allowed to do it.
That's true.
And yeah, and because they're not allowed to do naked calls, they're also not allowed to do ratio call spreads. But I'm going to show you where anybody that is qualified to do a spread trade, just a plain vanilla, like a
vertical spread
or a bear call spread. Yeah, vertical spread. If you're qualified to do that, you can do the ratio call spread in the context that I'm going to show. Also, if you're only able to do covered calls, there's a way to take advantage of this play also. Now, why would you want to take advantage of this play? Well, it's possible to take away all the risk that's represented by this red area. And I'll show you how that's done here in just a moment. But this is Carol's option, not to make a pun. She can sell two July $125 calls for $3 a piece, and that's going to generate $6, right? And use that $6, use some of it, use $5.50 of it to buy one July 120 call. So that would generate a net credit of how much?
50 cents total.
Okay, right. So it's 50 cents on the front end, and there's a possibility later on that you might get paid again, but there's also a big problem brewing here, okay? So the objection is, doesn't that put even more at risk? That's an infinite liability. You get 50 cents, but there's infinite liability. Well, no, there's not. Where does that liability come from, Mike, in the ratio call spread?
Now, having one call that's naked. One of your calls is covered by the long call that you purchased. The other one has nothing covering it, so you have infinite risk to the upside. As part of a nested trade, what happens, Kurt?
Yeah, if we do it in the context of owning the stock, I mean, if we own the stock and own it at a lower cost basis than that short call strike, we don't have any more risk. When you have the stock on hand to deliver, there's no risk to your capital for doing the ratio call spread. Here's another way of looking at it. You've got two short calls and one long, right?
Yes.
If you own 100 shares of stock, then one of those short calls is covered by the long call, and the other short call is covered by the stock. It's a covered call trade. Here's another way to look at it. It's like having a bull call spread, one long 120, one short 125, and financing it by doing a covered call, selling one call at the 125 strike. Okay? And this is actually using the PowerOptions software, Mike. I put this together. This is the actual risk-reward graph of all four legs that we've described: buying the stock, buying the put option, and doing the ratio call spread. So we've got 100 shares. We've got those shares protected by one put. We've got one long call. We've got two short calls. Everything's here, Mike. There's no break-even line. Right?
No, you're still bulletproof on this position, Kurt, yes.
Yeah, but there's this period of growth here between 120 and 125 that's crazy. See that?
Yes, accelerated growth period.
I'm going to explain why that happens, okay? Here's what's kind of exciting. Say you do hold the money net play until expiration, okay? You got paid to put it on. You got paid 50 cents, right?
Yes, we did. We took that into our account right away.
Okay, you still have the stock on hand, so there's no risk for adding that ratio call spread. There's no risk to your capital for adding the ratio call spread, okay? And the thing is, you can get paid again anywhere in this about $10 range, anywhere between $120.01 to $129.99. Why? Well, the initial credit we take on pays us a little bit up front, but let's say that the stock closes right at $125.
Okay.
What happens to those $125 calls?
Well, they still are going to expire. They're going to expire worthless, Kurt. We have no obligation to deliver shares of stock, so they just expire worthless.
Yeah, they expire worthless, and we're set holding a $120 call that we got paid to own, if you think about it.
Mm-hmm.
You know, we got paid 50 cents to put on the ratio call spread in the first place, and now part of that is this $120 call that we're paid to own, but the $125 calls are expiring worthless. So, looky, it's like we got paid to own that call, and it's worth $5 on expiration Friday.
Yes.
You know, if the stock closes, let's say the stock was at $123, okay?
Okay.
$123. Okay, so those 125s, they expire worthless.
Yes.
Yeah. Okay, and we're left holding a $120 call that's worth, well,
$3 of intrinsic value.
$3, yeah, and we got paid 50 cents to own it in the first place. How about over here? How about the stock closes at, let's say, 126? Okay. Well, if we buy to close those short calls, those short $125 calls, it'll cost us $1 a piece, right?
Yes. Mm-hmm.
And since there's two, it'll cost us $2. But this long call is going to be worth $6. Isn't that something? So we have to pay a management of $2, but our call option is our $120 call option is worth $6, and we've been paid to own it. All right, so it's really kind of fabulous. I mean, in this area, in this $10 range, we can catch a lot of extra premium. Okay, and so it's really exciting. So paid 2 times, yeah, you get paid 2 times. We've talked about how doing this ratio call spread in the context of ownership of stock takes away the risk, right?
Mm-hmm.
It takes away the risk. But then we get this initial credit, and then depending on where the stock ends up, okay, anywhere in this zone we can get paid again. Anywhere in the zone we get paid again. If the stock's price keeps going up, do we have any of that risk to the upside?
No, we don't.
No. Okay. So, folks, what I've just shown you is you're not seeing this anywhere else. I mean, there's no other stock trading guru or options trading guru that talks about nesting this kind of a trade within your married put play. But it's really exciting. You're able to pick up a credit on the front end, and there's a very good possibility you can pick up a credit again.
We need to pause for a moment before we go into this next part of the discussion. Because Jeff brought up a point, and I want to make sure that everyone's clear on this. Now, Kurt said there isn't going to be an advertisement, and I'm not advertising right now, but I'm kind of clearing something up. And the reason why is because Jeff wrote in and said, my account is only for covered call and long calls and puts. Jeff, that's the same restrictions I have at my Fidelity account where I do most of my radioactive trading. What we're showing you today, before I go into discussion of how you can do this in your account, this income method, what Kurt just showed you was one of the 11 techniques that's described in his full work, The Blueprint, that can be used to adjust this position, to lower the risk of an existing married put or help pay for the bulletproof status that he showed. This ratio call spread is one of the 11 income methods that are used. Now, your concern about, hey, this ratio call spread, what you just showed me, I can't do because I can only do covered calls and long calls. In a position I just opened, I'm tracking 200 shares of stock and I have 2 puts. I can still do this ratio call spread, Jeff. I can't sell 4 calls and buy 2, but I can sell 2 calls and buy 1. My broker only sees that as a covered call, which is protected by that long-term married put, because I can buy puts. So I bought stock, I bought a put. Now I'm selling 2 calls against my 200 shares. My broker just sees that as a covered call, and I'm buying an extra long call. I'm taking advantage of the ratio call spread. I'm not doing it at a full 2-to-1 ratio against my shares of stock, but I can still get that accelerated growth. And by doing it at this ratio, where I'm selling only 2 calls against my 200 shares and I bought a long call, I still have an infinite upside profit potential because 200 shares of my stock are covered by those 2 calls, but now I have the long call that I was effectively paid to own, which will still gain as the stock continues to move up in price.
That's right. You know, the thing is, it's difficult to form a mental picture of what Mike was talking about unless you're already familiar with it. So you know, maybe I'll add some other slides. But Jeff, yeah, the fact is if all you're limited to being able to do is to buy long calls and puts and to sell cover calls, it is possible to do a variation on this setup and still take advantage of all the benefits.
And of course,
really
with that,
exciting.
yeah, it's really exciting. And with that restriction as well, you'll still be able to do most of the other 11 income methods that I just referred to as well.
That's right. There's 11 income methods. I think number 8 he couldn't do, and number 7 he couldn't do, but most of the others are open for business. So very good. All right. So Mike, in summary here, if Carol's stock goes down, she'll be glad that she picked up the put, right?
Oh yes, because she's guaranteed to get that $30 back.
Very good. Oh gosh, very nice. Somebody jumped in and said, "You're doing great. Thanks for this education. Please keep up the great job." Thanks, Zaya. I appreciate that. Okay, so the thing is, Carol's stock, if it is protected, and she's also just picked up a 50-cent credit, it's possible she may pick up more, but she'll definitely keep that 50 cents, okay? And she'll be happy that she picked up the put. Now, if the stock goes sideways, well, that ratio call spread is going to pay her a second time. It's going to pay her a second time if the stock goes sideways. And even if it goes up, the money net can capture as much premium as she spent on the put option. And there's also management opportunities, too. We can't go into all of them because there's so many different ways to manage this play. If your stock goes up, it's really kind of exciting. But I'm going to go ahead and show a possibility. Okay, now here's an alert. This presentation that I'm showing today, what is it, October 25th or 26th?
Yeah, that's the 25th, Kurt.
Okay, we first showed this setup when Carol wrote in and said, "Hey, I've got stock that's up." Okay, we showed her the setup. So here's what happened on July expiration. At July expiration, Visa closed at $125.75. All right, so we had what, one long $120 call and 2 short $125 calls?
That's right, Kurt, yes.
Okay, so let's take a look here. This is one of the different ways to manage this. We're just going to show one because it's all we can do. If we buy to close one of those 2 short calls, buy to close one of those $125 call options, you would be able to close it at 90 cents or so, kind of close to the end of the day. Be able to get out at 90 cents. Okay. Now the stock has gone from 120 to 125. Remember, we assembled this whole thing. We bought the put, and then we also did the ratio call spread. We did all that in June when the stock was at 120 bucks. Now it's at $125. Mike, by closing this short call, I get to hold on to the stock, right?
That's right.
Okay, so I'm spending 90 cents to hold on to a stock that's up $5. So in my book, that's a $4.10, gain. But I call this double dipping. Okay, this is really exciting. See, the money net is composed of one long $120 call and 2 short $125 calls, right?
Yes.
Now, in the previous slide, I just showed closing one of the shorts for 90 cents. That's the short that's written against the stock. So what happens with the rest? What's left?
Well, you still have, you've got the long 120 call, 1 short 125 call, and stock in the put. You close one of the calls, you still have 1 short call open, 1 long call at 120, the put option, and your stock.
Yay! You know what's exciting about that?
Well,
That's
it works
a
out to
bull
be,
call
yeah.
spread.
And it was a bull call spread that was done at a credit. And if you open this normally as a vertical spread, you're going to have to pay a debit. You were able to get this position, the benefit of this spread, at a credit from that income method number 5 transaction.
That's crazy. I got paid to own this bull call spread. I got paid to own it. Got paid 50 cents. I just paid 90 cents back, to make sure I didn't lose my my stock. Okay, but the exciting thing is, after paying that 90 cents, I've got a guaranteed $5.
Mm-hmm.
Kind of cool. Did you get that, folks? Here's the deal. We took in 50 cents at the start to do the ratio call spread. I spent 90 cents to keep the stock, and the stock is up $5. And got paid $5 again for the bull call spread, and we got paid to own that bull call spread. So it's a total in of $5.50, and the management cost to close one of those short calls of 90 cents. So again, we got paid twice. We got paid 50 cents at the beginning, got another $4.10 at the end, and we're sitting on a stock that's up $5. So is that a happy day?
We're looking good, Kurt.
We're looking good, okay? That's kind of really exciting, okay? What had been the problem for Carol? Carol had her stock at an 84.60 cost basis and a present price of 120, okay? But she had no guarantees, okay? What's possible? Well, we were able to build a fence around the stock with options. We grabbed 50 cents right away with that ratio call spread, and then more, and we had the possibility of getting more later. In the case of Visa card, it ended up being $4.60 caught in the money net while the stock was rising. Okay, so before the stock is unprotected and stagnant, now the stock has got a nice warm overcoat and an intriguing possibility. We might capture more with the income methods than we spent on the put option to protect it. We could really do that, okay? Here's the deal. Remember this? The Visa shares were $84.60, and we spent $10.40 on that $125 put. So the total invested in is $95. We're guaranteed to be able to get out at $125. So out of the 35 and change gain that Carol has seen in her stock, we've got 30 of it guaranteed, right? We've got 30 of it protected.
Mm-hmm.
All right. Carol had been in this place where she had a $35.40 gain to protect, and now it's more like she's been paid $4.60, right, with the money net. She's got that in hand right now, and she hasn't sold the stock. And she still has this situation where she's only spent $95 for a position that's guaranteed to be worth $125.
Mm-hmm.
So she's still got her $30 gain locked in, and she's got $4.60 in hand without having to pay any capital gains tax. Ooh, is that a happy place? What's different now? Well, she can still cash in that stock at $125 no matter what happens to the downside. $4.60 of the money that we spent on the put has already been handled, all right? We played that ratio call spread in July, but remember it's a September put option. So we've got August, we could do another ratio call play. We got September, we could do another ratio call play, or we could do any number of 10 other income methods. That's what's really cool. So that's the place that we're at. Okay, Mike, here's the PowerOptions screen of Visa for Carol after putting on the stock, the put, and the ratio call spread. See this period of accelerated growth here between 120 and 125?
Mm-hmm.
That's because her stock is gaining, but her long call that she's been paid to own is also gaining. And since Visa finished at $125.75, she double dipped. She got more than if she had simply been holding the stock. Really cool. Okay, now we're going to open it up to questions here. Okay, but I know one question that's nagging everybody, and the reason I know that is because it got asked on Tuesday. So Mike, let's go ahead. I'm going to ask everybody if you have questions to start queuing them now, because we want to finish at the top of the hour. We've only got 8 minutes left. Okay. Go ahead and start queuing those questions if you got questions. But this major question I'm going to handle right now. What if you don't have a stock that's up $35 from where you bought it? What if you don't have a stock that's up $35? Well, Mike, could all of these things been done in the context of a stock with a higher cost basis?
Yes.
Sure. Okay. Yeah. Carol was able to pick up Visa months before, maybe even years before, at a lower cost basis. But if she got it on that day, in June when it was trading at 120, she would still pay $10.40 for the put. And this would be her situation. She'd have a total invested amount of $130.40, and she'd be guaranteed to be able to get out at 125 because, after all, $125 put. So, Mike, what's the real at-risk amount in this play?
Well, it'd still come out to be the time value in this case of $5.40.
Right. Okay. I'm going to do a little bit of math here. I'm going to work this out. So $5.40 is the amount that's at risk, divided by the 130 that we've put into it, that we've put into the play. So if we lose the entire amount, if Visa falls out of bed, we're looking at a loss to our capital of about 4%.
Mm-hmm.
Now here's the deal. That wouldn't have happened because we did the ratio call spread that picked up another, that reduced the break even, and the stock went up. Okay, so we wouldn't have had a loss. But if we did have a loss, that loss would only be single-digit percent. It'd be 4%, right?
Yes.
All right. Now here's the break even. The break even is the difference between your strike price of your put and how much you've spent for your stock and your put. In this case, what we spent for our stock and our put is $130.40, but we're guaranteed to get out at $125, right?
Mm-hmm.
After doing the money net, the ratio call spread, that would have reduced some of the risk. Remember, the money net captured $4.60, so there'd be less risk. And so that $5.40 at risk from the previous slide is offset by the $4.60 income. Mike, we're pretty close to bulletproof already. What's bulletproof mean?
Well, it means that your guaranteed exit of your put option, the strike price of the put, is at a higher value than your total amount invested into the position.
Right. And if we had gotten in on the day that we initially showed Carol how to protect the gains she already had, if we didn't have any gains to speak of at all, we just got in on that day, and we still followed the same steps that we showed Carol, well, we'd be bulletproof, and here's why. Income method number 5 would have taken care of $4.60 of the cost of the put, but then we could also do income method number 4, which we don't have time to show today, but we have showed in other presentations. And that would mean that our hero would be sitting on a stock and a put option, which the stock and the put option cost less than the put is guaranteed to bring back.
Right.
And we'd still have unlimited upside potential. That's a really exciting place to be, okay? So, Mike, I'm going to ask another poll here, okay? When we asked, are you happy with your 12-month performance? Okay? Some folks were ready to quit. Some folks had mixed emotions. They'd gotten hurt. 44% said that they're making money but not enough. Okay, now let me just ask this question. If you limited risk like what we showed, less than 6%, okay, in this case it was 4%, but if it's less than 6% of the trade itself, and if you diversified enough, you know, that you'd only risk, say, 1% of your total capital, well, how much better would you have done last year? How much better would you have done last year, not even considering the income methods, but just considering this, if you were able to keep your losses down to 6% or less in each trade? would it have made a difference to you? There's 5 different answers. One of them is, hey, I did keep my losses down to 1% or less of my capital, 6% or less of each trade, and I still lost last year. So far, nobody's plugged in that one. Here's another possibility. I might still have lost, but you know what? I would have lost less. Or, hey, I lost overall last year, but I would have won if I'd have done that. Or I won last year, and I would have done even better if I'd have done that. Or I would have been one of those guys that said, I'm very happy with my trading. Mike, how many said they're very happy with their trading today?
Well, it was 0%, Kurt.
0. Nobody said it. Okay, let me go ahead and close this poll and share the results. Okay, not everybody got a chance to vote, but of the folks that did, 25% said, hey, I might still have lost, but I would have lost much less. 25% said, I won last year, but I would have done better if I'd have done that. And 50% would have been one of those that said, I'm very happy with my trading. And today, no one, in fact, said, I'm very happy with my trading. Nobody was in the absolutely kicking butt and taking names category. Okay? So that's pretty cool. Let me ask you something, folks. What do you think of spread trades that take income but don't have any risk? And Mike, did a couple of questions come in that we could handle?
Well, I handled a lot of them, but most of them were I don't know if we want to share with the audience right now because they're related to blueprint owners asking other questions about other income methods and so forth.
So we have some folks on the line that are already own the blueprint.
Yeah, recent blueprint owners who had questions about, if I do this method, should I look to do this right away? But we have one from Caesar that's kind of important. What you showed on Tuesday and what you showed today is a stock that's moved up. And we talked about the income method there and, of course, from scratch. But how could this help Caesar if he's got, and I know some of our other clients or attendees are in this position as well, the way the market's been the last week or so, how can the radioactive trading techniques help them with a stock that's currently underwater? What do you think about that?
Oh, boy. Well, the thing is that the insurance, and I don't mean to sound calloused or cruel or anything like that, but listen, the time to buy insurance is before you wreck your car, right? The time to buy insurance is before you get into trouble. And I've been saying this, and I've been beating this drum for over 10 years. And in November of 2008, you can bet that I got a lot of thank you letters, okay, because I had been beating the drum particularly hard early that year. But how can radioactive trading help? I'll tell you what. Stop doing it. Stop buying stock without protecting it, okay? And for me, the lesson was really hard won. It was a hard lesson because I actually was buying stock on margin, Mike, in order to do my covered call trades. And you know how that story ends.
You ended up losing your life savings and then trying to develop this new technique.
That's right. And developing this technique basically meant doing everything that I had been doing backwards. I thought, geez, my behavior got me into trouble, so why don't I start to figure this out and do everything backwards? And I did. And after many years of tweaking and adding to that, we've gotten quite a bit of new techniques out of it. Let's see. So let me go ahead and share this. 64% say beats the shiitake mushrooms out of covered calls. Yeah, it does. And since 80% of you are doing covered calls, it bears looking at. Mike, it's a bearish hedge to short a call, isn't it?
It's a bearish play. Anytime you sell a call, whether you own stock or not, well, selling a call is a bearish play. Let's just go that way.
Yeah, selling a call is. Now, selling a covered call is net bullish. It's net bullish because the biggest segment of that play is
stock ownership.
Stock.
Yeah.
Well, hey, a married put is also a net bullish play. It's a net bullish play with a small bear hedge, right? Buying a put is bearish too. The only difference between the married put and the covered call is this. The covered call pays you a small credit so that you have the privilege of sitting on your stock, which may turn out to be a loser. The married put play protects you from coming out too big of a loser, but it leaves the upside open. The only catch is you got to pay to do it. And when you pay to do it, guess what? The income methods are meant to offset that and keep you out of trouble. It's kind of cool. It's kind of cool. Okay. All right. So, Mike, I'm going to wind this up. Now what for everyone? I don't know. If it was me, I'd keep coming to these free webinars. I go to the RadioActive Trading blog and read about limited risk but unlimited upside potential trading. I get as much free tools and training as possible. Maybe I'd even pick up the blueprint, but I'm not gonna do some kind of last-minute sale or anything like that. And folks, I'm not even going to point you out to where to get it. Okay, if you're grown-ups, if you want to pick up the blueprint, you know where to probably go. So here's something I want you to do right now, though. I would like for you to, I'm not going to even advertise RadioActiveTrading.com, okay? I'm going to talk about PowerOptions. Mike, the PowerOptions platform is what I use to show everybody these plays, right?
Well, it's just the custom spread tool and the profit and loss charts, right?
Yeah, I only use like the tip of the iceberg in order to show, but PowerOptions is the best tool. I just sent a link to everybody so that they could pick up a free 2-week subscription to PowerOptions. It's the best tool for finding these kinds of trades and evaluating these kinds of trades, but not only these kinds of trades, but like 22 other option strategies. And I'm thankful that you take time out of your day to, meet with me and talk about the radioactive trading methods. But but Mike's like I say, he's the options trading education. What is your? I'm sorry. What is your title again?
The Director of Education, the Director of Options Education here at PowerOptions.
There it is. Okay. And certainly, whatever plays that you're doing, I would really look into married puts. Okay, but whatever plays you're currently doing, the best tool to evaluate them is to see what your risk and reward look like. This is all available on PowerOptions. Okay, www.powerup.com /RAT, and I sent the link out as well as, you can't click on this on the page, okay, but you can click on that link that I just sent you. And highly, highly, highly recommend that you get set up for a consultation with Mike. Okay. Mike, so did we handle all the questions that we had?
Yeah, I mean, there was a follow-up question regarding the, I'm sorry, folks, how does PowerOptions relate to radioactive trading? Well, Kurt kind of just covered that. PowerOptions is a suite of tools for self-directed options investors. You want to find the new positions, analyze them, compare them, run your what-if scenarios. Kurt, we talk about that in the blueprint using the custom spread tool. PowerOptions is designed for self-directed investors. We do support over 23 different strategies, but it just helps you save so much time with your research and analysis and tracking and managing positions with the portfolio tools to help. New question that came in, I think you mentioned it, Kurt. You were trying not to, but I think you did, and hey, that happens. Robert wanted to know what is Fusion you spoke of. Well, at RadioActiveTrading.com, members or investors or attendees or anyone who buys the blueprint, let me go that way, can get their first month of Fusion on RadioActiveTrading.com for $10 and $69 a month after that. What is Fusion? Fusion offers a basic search tool to look at new married puts powered by PowerOptions, so you can look at potential married put trades following Kurt's strategy. There is a stock insurance tool there, so if you have a stock that's moved up in price and you want to see what puts you could potentially buy, that's available in the Fusion service as well. Kurt has put together a plethora, for lack of a better term, but a lot of lessons there to help investors absorb the materials of the blueprint, and there's also the open trades where you can track the Fusion positions, the married puts that Kurt has open right now, and some of them that are actually my positions that are in the Fusion portfolio right now, and the Ernie at PowerOp portfolio, which is Ernie Zarrenner is the president and founder of PowerOptions, his married put trades. You can follow those as well. So that's what Fusion is.
Very cool. Mike, I put up a final poll, and I guess we should go ahead and break, go ahead and finish up. But I put up a final poll for my information purposes. I just wanted to see what folks got out of today's presentation, the best thing that they got out. So was it limiting your risk down to single digits with something better than like a stop order?
Mm-hmm.
Was it seeing how you know what, we didn't actually use the moving the put, although that's income method 4.
Right.
Did you like seeing how a spread could take income, but still have no risk?
Mm-hmm.
And did you appreciate that the structure of a trade is more important than the trade itself? Structuring it in such a way that it can't hurt you if it goes one way, but if it goes another way, it gains more than than the stock itself normally does. And then finally, bulletproofing. Is that the most useful? So, guys, thanks for participating in today's lesson, and thanks especially for the results of this poll. I'll go ahead and close it and share it with everyone. And Mike, I'm going to go ahead and close up today. We'll see you again on Tuesday for another free lesson from RadioActive Trading. It probably won't be this lesson. We'll probably do income method 4.
Okay. All right, sounds good. That's one of my favorites. You know that. Hopefully, maybe by Tuesday, I might have had a chance to do another one. We'll see.
Hey, very good. That's right. Yeah, you've got some active trades right now. So
that's right.
Very good. All right, Mike. Thanks so much, and thanks everybody for coming. We'll see you out there. Happy
trading.
All right,
take care, everyone.